have our midterm test on time. Okay, so today we will finish chapter 3, and if you have any questions related to your exercise, your test and your exam, so we will discuss about this in today's lecture. Okay. Uh, yeah, so this is where we stopped in a previous lecture. You already learned about the equity, and you know how to like pricing a common stock. Okay, so remember that when we talk about stock, the cash flow comes from the stock is firstly the dividend. Yeah, and beside the dividend you also have like other type cash flow, but in order to find the reasonable price of the stock, we only use the dividend. And for the dividend, you will have like several types of dividend. So the first one is when you have the dividend paid like an equal amount periodically, maybe annually. So if your dividend are equal amount every year, so in this case you can understand that your dividend cash flow is the perpetuity. And in order to pricing a common stock with equal dividend payment, you will use the PV function of perpetuity, right? So, yep. For let's say in the first case, when we have the zero growth dividend, so this means that your dividend equal every year. So in this case, we will apply the formula that PV equal to D divided by R. And in the second case, when we assume that the dividend of the firm like increase at a constant rate over time, let's say we have a fixed growth rate of dividend payment. So in this case, you can understand that the cash flow for the stockholders are the growing perpetuity. This means that the the investor could receive like increasing amount of dividend after every year. Yeah, and because the dividend like go to indefinite time, so this means that for dividend we do not have like the maturity, and therefore we will apply the function, the PV function of growing perpetuity. And the formula you use here could be PV equal to D1 divided by R minus G. And for the last case, when you have like non-constant growth, so the dividend payment can grow at some rate in early years, and then it will grow at a constant rate in like the years after that. So in this case, you can see that we have like different phases of dividend payment, and normally we will assume that the growth rate will be constant after a finite length of time. Okay, so you can see some exercise that we have two phases of uh, growing dividend payment. Some exercise it is more complicated. You can have some dividend with like three phases of growing. So in this case, always remember that the last phase will be the growing perpetuity. But for the dividend in like the first phase or the second phase, then you will discount each dividend payment to present time. Okay, so that is how we try to value a common stock with the stream of dividend payment. And beside the common stock in the market or for the firm can also raise funds by issuing other type of equity, in which we call the preferred stock. Okay, so preferred stock is another type of equity securities, and it gives the holders certain privilege over common stockholders. Okay, so what are the privilege here? So the stockholders, the preferred stockholder, can firstly receive a fixed periodic payment of dividend of preferred stock. So you can see that for the common stock, the firm will have the right to pay dividend or not. But and the amount of dividend payment for common stock can change over time. But for preferred stock, the dividend payment is fixed. It's a fixed amount, and it is stated at the initial issuance of preferred stock. Okay, so it is a fixed amount, and it is um, it is the amount that the firm promised to pay to the preferred stockholders. Okay, and the preferred stockholder can like receive this payment periodically. Yeah, so it does not depend on the operation of the firm. It does not related to whether the firm is making profits or loss, but the firm has to pay the dividend payment to the preferred stockholders, and it must be in a fixed amount. Okay, so that is one difference between the preferred stock and the common stock. And yeah, another privilege of the preferred stockholders is that they can receive a dividend before the holder of common share are entitled to anything. So if you hold the common stock and your friend holding the preferred stock of the same company, then your friend could be paid the dividend payment before you to receive the dividend payment from the common stock. And in the case of bankruptcy, the preferred stock claim is honored after that of bonds and before that of common stock. Okay, so you can see that if we have like three investors, uh, one holding bond, one holding preferred stock, and one holding common stock. Then, if the firm are forced to go bankruptcy and the firm has to sell all of its assets to collect the cash back, then the cash will be paid first to the bondholders, and then what is remaining will be paid to the preferred stockholders. And after that, after all of other stakeholders of the firm are satisfied and paid back cash, then what remains will come to the common stockholders. And yeah, it is the usual case that the common stockholders have nothing less. Have has nothing left after all other stakeholders are paid. Yeah. So these are like several privilege of the preferred stockholders if you compare it with common stockholders. Okay. And although that the preferred stockholder have some like um, preferences and some priorities over the common stockholders, um, the thing that they do not have, if you compare common stockholder, is that the preferred stockholders do not have the voting right. So if you are the investor that holding the preferred stock of one company, you will not have any voting right in involving in any decision of the firm. So let's say if the firm want to like um, restructure or like want to change the charter capital, so the firm has to ask the opinion of the common stockholders, but the preferred stockholders could not have anything doing with the decision of the firm. So basically, the preferred stockholders do not have any voting right, and they will not be allowed to involve in any operation and decision of the firm. Okay, so you can understand that preferred stockholders are not the owner of the firm, like common stockholders. Okay, so these are some characteristics related to the preferred stock. And yeah, from the firm's perspective, from the issuance of, from the perspective of the issuer of preferred stock. So payment of dividend is not a liability of the firm. It is the same with the common stockholders, right? Because if the firm cannot like make the preferred dividend payment on time, so uh, the investor will not be able to force the firm to go bankruptcy. And yeah, the payment of dividend is not a business expense and not deductible for tax purposes. So this means that the amount of money that the firm used to pay dividend for preferred stockholders are taken from the net income of the firm. So the preferred dividend payments will not be included in the operating expense of the firm, like interest payment. So if you compare between the preferred stock and the bonds, you can see that interest payment will be included in the operating expense, and it will be deducted when the firm calculates the profit before tax, and therefore the tax paid to the government would decrease if the firms are using bond. Yeah, and this will help the firm to save some amount of money from the tax paid to the government. But it is not the case for the preferred dividend. Yeah, so preferred dividend is the same with uh, common dividend. So they are all withdrawn from the net profit of the firm. So after all of the operating expense has been calculated, the firm will have the profit before tax, and then they calculate the tax paid to the organization and come up with their net income. And with that net income, the firm will spend some part of the net income to pay the dividend to the preferred stockholders. Okay, so as you can see that the payment of dividend in this case will not deductible for tax purpose, and it is not the tax shield for the firm like the bonds. Yeah, so you can see that for preferred stock, it has some characteristics similar to bonds, and it also has some characteristics similar to common stock, right? Mm, you can see here if you relook at the characteristic of the preferred stockholders. Yeah, it has some features that similar to bond, such as that the preferred stockholders do not have voting right. They cannot involve in the operation of the firm, and what they receive from holding the preferred stock is the dividend payment, which is fixed at the beginning of the issuance of the preferred stock. Yeah, and it is the same as the bondholder, because like the interest payment and the principal payment to the bondholders are fixed at the beginning. So when the firm issue the bond, they already tell to the investor that they will pay some fixed amount of money to the investor, and it is similar to preferred stock. So basically, these are some like uh, the same features if you compare between the preferred stock and bond. However, the preferred stock also like have some features, share the same features with the common stock. Like if the firm cannot pay the dividend payment on time, then the the preferred stockholders cannot force the firm to go bankruptcy. So it's the same with the common stockholders. And dividend payment here is not tax deductible. So you can see that it like have some features like the bond and some features like the common stock, and therefore um, you can see in some textbooks, in some news, in some like other media, they call the preferred stock as a hybrid securities. Yeah, hybrid securities. It has some the features of both common stock and bonds. So yeah, here I have listed some key points, and you can read the slide to understand better about why we call the preferred stock is a hybrid securities. Okay. Yeah, so no fixed maturity date, non-payment of dividend not result in bankruptcy, and not deductible for tax purpose. So these are the features of both preferred stock and common stock. And yeah, fixed amount of dividend payment and no voting right are the same, the similarities between the preferred stock and corporate bonds. So please remember about this thing, okay? And for you, in order to valuation of preferred stock, so in previous lecture, you learned about how to find the intrinsic value or the reasonable price of a common stock. Yeah, and you use the formula, the PV of like either the perpetuity or growing perpetuity. And how about the preferred stock? How can we evaluate the price of the preferred stock, or which price that you agree to pay for the preferred stock at present time? So in order to like valuation of preferred stock, so yeah, we do the same thing with what we do to bonds or to common shares, that you will discount all of the future cash flow that you receive from holding the preferred stock and back to present time. And you know that for preferred stock, yeah, the dividend payment is a fixed amount, and you will receive it like periodically every year to infinity. Yeah. So if you imagine about the future cash flow of the preferred stock, let's say you receive $10 this year, okay? $10 next year, and $10 2 years from now, and etc. until indefinite time. So basically, this one are the dividend payments from the preferred stock, and you can see that this type of cash flow, it is obviously the perpetuity. Yeah, we receive like an equal amount of money periodically and in indefinite time. So yeah, this one is perpetuity. So the present value of a preferred stock can also be calculated using the function of perpetuity. So it could be equal to D n divided by R, in which D is the dividend payment and R is the required rate of return to the investor. You clear this point? Yes or no? Oh, some of you raise your hands. This means that you already clear, right? Okay. Okay, very good. So that is about the equity securities. And the last type of instrument we learned in this chapter is about derivatives. Okay, derivatives are Vietnamese phái sinh, công cụ phái sinh. Yeah, so derivatives are financial contracts whose values are derived from the values of underlying asset. So here you can see that we will have something we call the underlying asset, and the derivative will have the price, the value that are linked with this underlying asset. Okay, and yeah, how can we understand what is the nature of a derivative? Okay. Okay, so let's look at this example, okay? So let's say we have the situation that we have two firms. We have two firms, A and B, okay? So firm A would be the importer or the buyer, and firm B could be the exporter or the seller. And let's assume that firm A will import some, let's say, the coffee beans, from B. Okay, and you can understand that as an importer, the company has to manage its cost. Okay, because like it buys some goods or products from another firm, so it has to manage the cost, like uh, the lower than the better. Okay, so they try to manage the cost of coffee beans that they can purchase from company B. So let's say at present time, so today, for example, the price of coffee bean, I, I denote it as S0, in which S is the spot price, okay, spot price. So spot price at today times 0, let's say it is $1,000 per ton, okay? And basically, company A has to purchase the coffee bean at this price. However, after like analyzing the trend of the coffee bean price in the future, company A expect that 1 year later the price of the coffee bean would increase. Okay, so they expect that 1 year later, so the expected spot price can increase to, let's say, $1,000 per ton. Okay, so this is the expectation of company A. And as the buyer of coffee beans, they will not want to buy the coffee bean at this higher price, because it means that the firm will have to suffer higher cost. So the firm want to set a limit for the price of the coffee bean at the moment. Okay, so how can it do that? The company A will go to company B and offer a contract that, in which, in this contract, the company A will agree to buy 2 tons of coffee bean from company B in 1 year from now, okay, at a price of $1,300 per ton. So this is what the company A offer to company B at the present time. Okay, and if the company E, if the company B, they agree to um, to make transaction with company A corresponding with these terms, then two parties will um, will make a signature, and they will agree with each other that after 1 year, the company B will deliver 2 tons of coffee bean to company A and receive uh, $1,300 multiplied by 2, which is $2,600 from company A, company A. So that is the contract, okay? And these are what two companies agree at present time for a transaction that happen after 1 year, okay? So let's say um, after 1 year, so 1 year later, then you can see that the spot price, okay, the spot price of the coffee beans can fluctuate. So they can either increase or decrease compared with the spot price today. Okay, so let's say if the actual price of the coffee beans in the market 1 year from now, they increase, and they increase to the price of $1,400. Okay, so the price of the coffee bean in the market is $1,400 per ton. But because of this contract, then party B would have to deliver 2 tons of coffee bean to company A and only receive $1,300 per ton for this coffee bean. Okay. Although that in the market, coffee beans are traded at the price of $1,400. But because these two parties already signed the contract, So party B has to sell the coffee bean to party A at the price of $1,300. You can see that if we look at this transaction, we can easily estimate the profit and loss of each party for this contract. Yep. So whether the party A have a gain or loss from involving in this contract, whether have a gain or loss. Price of in this case, realize a gain from the contract. So this is the price in the contract and the price in the market. The price is less than the price the buyer of the coffee.
Cô nhờ cô xem lại mic được không ạ? Bọn em không nghe gì cả.
Các bạn nghe được cô chưa ạ? Alo.
Dạ, giờ thì rồi ạ.
Các bạn nghe được cô rồi đúng không?
Vâng ạ.
Ok. Các bạn biết là chúng ta đang dừng lại phần nào rồi đúng không ạ? Chúng ta đang học về derivative contract. Và ở đây thì cô đang nói cho các bạn chúng ta hiểu cái bản chất của derivative nó là cái gì. Ok. Các bạn thấy rằng là chúng ta đang có hai bên đúng không ạ? Chúng ta có buyer và có seller. Thì ở đây cô đang giả định một cái tình huống đó là hai người này họ đang giao dịch hạt cà phê với nhau, đúng không ạ? Và bên anh A là người mua và anh B là người bán. Các bạn thấy rằng là từ góc độ là người mua thì người ta sẽ cố gắng để giảm cái chi phí của mình ít nhất có thể. Cho nên là trong trường hợp là hiện tại giá cà phê đang là 1.000 đô một tấn. Nhưng mà cái bộ phận phân tích của bên công ty A họ dự đoán, họ kỳ vọng rằng là một năm sau cà phê trên thị trường có thể tăng lên mức 1.500 một tấn. Thì công ty A họ sẽ cố gắng là giới hạn cái mức giá, cái sự tăng lên của mức giá này. Cho nên là họ mới đề xuất với bên công ty B là hai bên sẽ ký kết hợp đồng với nhau, được chưa ạ? Trong đó trong cái hợp đồng này thì ghi rõ rằng là bên A sẽ mua từ bên B là 2 tấn cà phê và cái việc mua này sẽ diễn ra vào một năm tới, được chưa ạ? Và cái mức giá trong hợp đồng sẽ là 1.300 đô một tấn. Thì ở đây điều này có nghĩa là gì ạ? Có nghĩa là sau một năm thì dù trên thị trường giá cà phê nó đang là như thế nào thì bên B vẫn phải giao 2 tấn cà phê cho bên A và nhận về một số tiền cố định là 2.600 đô. Số tiền này nó đã fix ở thời điểm hiện tại rồi, được chưa ạ? Nó đã fix rồi. Và không quan tâm xem là một năm nữa thì giá cà phê sẽ như thế nào, nó có thể cao, có thể thấp, có thể tăng, có thể giảm. Nhưng vì hai bên này đã ký kết hợp đồng cho nên là gì ạ? Cái giá ở đây nó đã được chốt là mức 2.600 đô. Vậy thì ở đây cô đang giả định là sau 1 năm thì thị trường giao dịch cà phê với mức giá là 1.400 đô một tấn ạ. Ở đây chúng ta có S1 là 1.400 đô ạ. Thì cô đang hỏi lớp mình là khi mà chúng ta có thông tin về giá cà phê trên thị trường như thế này thì cái lãi lỗ của hai bên khi tham gia hợp đồng này là như thế nào? Cô đang hỏi các bạn là theo các bạn thì bên A họ đang có một cái gain hay là một cái loss khi tham gia hợp đồng, và bên B ạ, thì chúng ta có thể xem là trong trường hợp này thì A tạo ra gain hay loss và cái mức gain và loss của từng bên là bao nhiêu ạ? Các bạn có tính được không? What is the gain or loss of company A in this case? What do you think? Is it generate a gain or loss in this case? What do you think? Or do you clear with our situation? You need me to explain the situation again? Yes or no? Hello? No one answer me. Okay, so if we compare between the contract price and the market price, you can see that the contract price now is less than the market price. So obviously, the buyer of the goods and product in this case, they were beneficial from the contract because they only have to pay contract price, which is lower than the market price. And therefore, instead of paying $2,800 to pay 2 tons of coffee bean in the market, party A only have to pay $2,600. And therefore, party A is generating a gain from the contract. Okay, and the amount of profit here is $200. And at the same time, if you look at the party B in this case, you can see that if the party B does not involve in the contract, they can sell the coffee beans to the market at the price of $1,400. But the party B decided to sign the contract and involve in the transaction with the party A, and therefore they can only sell 2 tons of coffee bean at the price of 2,600. So they will suffer from a loss of $200 in this case. And this one is what we call the value of the contract to each party. Okay, so the value of the contract, here is the contract. Okay, so here is the contract. So the contract will have the value to party A, which is plus $200, and the contract will have the value to party B, which is minus $200. Okay, and this is the first situation. And if you assume that we have the second situation, yeah. So in second situation, the price of the coffee beans trading in the market 1 year from now also increase as the expectation of party A, but they do not increase too much. Let's say after 1 year, the price of the coffee bean in the market is only $1,050. Okay, so this is the second case. So how can we value the profit and loss of each party in this situation? So you understand that $1,300 is something already fixed for both parties in this case, okay? No matter about the fluctuation of market price of coffee beans. So if the coffee beans in the market after 1 year traded at the price of $1,050, so in this case, the party A still has to pay $1,300 as promised. This is what already fixed in the contract, and because party A signed the contract, so he has to follow the price here, and therefore, uh, yeah, if the party A goes to the market and buy coffee, they only have to pay $1,050 per ton of coffee bean. But because uh, he promised to follow the contract, so he will pay at the price of $1,300. So in this case, you can see that the contract price greater than the market price, and therefore the cost to the buyer in this case will be higher than the market. And in this case, the party A will generate a loss from the contract. Okay, and yeah, the amount of the loss here, how much is it? How much is the loss? Sorry, in the second situation, what is the loss for party A?
500.
500. Yeah, correct. So yeah, you have you take this 1,300 and minus 1,050, and we multiply by 2. So the loss to party A is $500. And if we look from the perspective of party B, obviously party B in this case, they will generate a gain. Yeah, because instead of selling coffee bean at the price of $1,050 to the market, now party B can sell it to party A at a very higher price in this case. And therefore, party B will have a gain by participating in the contract. And the gain in this case is also $500. Okay, and this is the value of the contract to party A and party B in our second situation. And if you look at this example, you can see that actually the contract in this case does not have any value to the party involving in the contract. But the value of the contract here depends on the value of the coffee beans. And the coffee beans in our case, in this case, is the underlying asset. Okay, so the price of the coffee bean is the price of the underlying asset. It can fluctuate over time. It can increase, decrease. It can be high, can be low, and depends on the demand and supply of the market. So when the price of the coffee bean like change over time here, it will result in the change in value of the contract for party A and party B in our example. Okay, so you can see that the value of the contract either plus $200 or minus $200, yeah, minus $500 or plus $500 in this case. The value here depends on the price of coffee bean, and that is why we call this contract is derivative. Okay, it is derivative. It does not have actual value, but the value depends on the value of other asset we call the underlying asset. Okay, and if you look at this example, you can see that total value of the contract to the both party. So in the first example, if the spot price is $1,400, so party A will generate a gain of $200 and party B will generate a loss of minus $200. And if we sum this up, then it will be equal to 0. And this is the same for the second case. So if the spot price of the coffee bean is $1,050, so party A will have a loss of minus $500 and party B will have a gain of $500. And if you sum them up, then it's also equal to 0. And this one could be applied to every situation of market price of coffee bean. So whatever the value of this S1, you will have the profit or loss of party A plus profit or loss of party B equal to 0. This means that the gain for one party will comes from the loss of the other party. Okay, so the gain of party A in the first example comes from the loss of party B, and the gain of party B in the second example comes from the loss of party A. So for derivative, we say that it is the zero-sum game. So the profit of one party comes from the loss of the other party in this case. And that those are like some typical features of derivative. To clear the point? Yes or no? Yeah, I hope that all of you clear because it's quite clear, right? Okay, so some characteristic of the derivative here. It is a contract, yes, what we already illustrated in the example. Always refer to an underlying asset. In our example, is a coffee bean. Yep, and the value of the contract depends on the value of the underlying asset. Okay, so these are the general characteristic of the derivative contract. And okay, so for derivative, we will have some typical type of derivative contract. We have the forward contract, futures contract, option contract, and swap contract. But in this course, we only consider the first three types of derivative contract. Okay, the last type here, we do not cover it in this course. So for forward contract, yeah, forward contract are contracts that allow the purchase or sale of specified underlying asset on a specified future date at a fixed price that is agreed today. So basically, the forward contract is what we have in our example. Between party A and party B, the contract about the coffee beans is a forward contract. Okay? So the two parties will be able to purchase or sell of a specified underlying asset. In our example, is the coffee beans. Okay? On a specified future date, which is 1 year later, and at a fixed price, which is $1,300 per ton, and this price is agreed today. So basically, our example is example of a forward contract. Okay? So the forward contract is traded on OTC market. OTC. So if you remember about different types of financial market, we have the exchange market and over-the-counter market. Okay, so you just remember that for exchange market, it is something uh, that is strictly regulated by the government and the regulators, and we have many laws and regulations for the participants to be able to trade on the exchange market, and everything is standardized. Okay, but if we look at the OTC market, it is the playground for all of the participants, and it is like customized. It is customized, and it is like less strictly regulated by the government. So everyone can go to the OTC market. Everyone can quote at the price that they want to buy or sell, and yeah, providing that they can find the corresponding buyer or seller, they can make transaction. Okay, so for OTC market, everything is like much more free to do. The participants will have like more freedom when they trade in the OTC market. So yeah, the forward contract is customizable in terms of asset, in terms of future date, and in terms of the price. It can be any asset, can be any future date, and can be and can it can be any fixed price that is agreed between the two parties. Okay. Okay. And the payoffs for forward contract, which is the profit and loss of each party, that we calculate in our example. Okay, so remember that for the example I asked you about what is the profit or loss that each party generate from participating in the contract. So here we have the graph that helps you to um, uh, visualize the profit or loss of each party. So here we have the party A, who is the buyer, okay? And we have party B, who is the seller. So you can see that uh, ST here is the spot price at time T, okay? And the the vertical the vertical axis here is the payoff or the profit or loss of the contract to the party. So in the case that we have here is the exercise price. Okay, so this $1,300, we call it as the exercise price. Yep. So if the market price equal to the exercise price, so in this case, um, buying from the contract or buying from the market is the same. Yep, because the price in the contract and the price in the market are equal to each other. So buying from the contract or buying from the market is the same. And in this case, the profit to the buyer is zero. Okay, so as you can see, zero here. And it is also the case for the seller of the contract or the seller of the goods in this case. So if the spot price equal to the exercise price, then the profit to the seller is also zero. Okay, and if the uh, the market price of the underlying asset greater than the exercise price. So if the market price greater than the exercise price, so let's say after 1 year, the market price is $1,400. Okay, so obviously in this case, the buyer will generate a profit because they save $100 of purchasing the underlying asset. Yes. So instead of going to the market and purchase the asset at the price of $1,400, now they can go to the contract and buy the asset at lower price. So obviously they are generating a gain or a profit in this case. And yeah, this is the profit. So these are $100 a profit, or this is the payoff to the buyer. Okay, so the higher of the spot price, then the higher of the profit to the buyer of the underlying asset. Okay, so if you connect the dots, then you can see that it could be the upward line like this. And in the case that the spot price, the market price lower than the exercise price. So let's say here is $1,050. So the market price of the coffee bean after 1 year is $1,050. So in this case, obviously the buyer or party A is generating a loss from involving in the contract, right? Because like they can go to the market and buy coffee beans at the price of 1,050. But because already involving in the contract, they have to pay party B coffee beans at the price of 1,300. So obviously party A is suffer from a loss, and the amount of loss here is $250. Okay, so this is minus $250. And yeah, it's also the dot here, and you connect it. So you will have the line, and this line will tell you about the payoff of the forward contract to the buyer. Okay, and we can do the same for the seller of the contract or the seller of the goods in this case. So opposite with the buyer, if you look at the graph of the seller, then you can see that the the payoff to the seller here is a downward. Yep, it's a downward line. Okay, so uh, if you consider the case that the price of the coffee beans is 1,400, then the party B will suffer from a loss of minus $100. And in the case that the price of the coffee bean is $1,050, then party B will have a gain of $500 per ton. Okay, and therefore you can see that the higher of the spot price, then the higher loss for the seller. Okay, and the higher gain for the buyer. So obviously, if you are planning to involve in the derivative market and you expect that the underlying asset will increase in price in the future, then you will go to the derivative market, and you will act as a buyer of the underlying asset. Yeah, if you expect that the underlying asset will increase in price in the future, then you will go to the derivative market and you will buy that asset. But if you expect that some asset will decrease in value in the future, then you will go to the market, derivative market, and you will act as the seller of the goods. Okay? And if you are selling an underlying asset in the derivative market, then we call that you are taking the short position. And if you go to the derivative market and you act as the buyer, then you have a long position in the derivative market. Okay? So if you are the seller, then you are in short position. And if you are the buyer, then you are in long position. And if you expect that the underlying asset increase in price in the future, then you would take the long position in order to take this gain. Okay? But if you forecast that in the future the underlying asset would decrease in price, then you will go to the derivative market and take the long position. Okay? You will generate a gain in this case. You clear this point? Yes or no? Okay, so for the second type of derivative contract, we have the futures. Okay, so futures are standardized contract that allow the purchase or sale of a specified underlying asset at a specified price and date. So basically, the definition of futures and forward are the same. They are all about the purchase and sale of a specified underlying asset at a specified date and time. But the difference between these two, sometimes you will be asked about like differentiate between future contract and forward contract. So remember that for forward contract, you are transaction in the OTC market, okay? But when we talk about future contract, then this type of contract is traded in the exchange, okay? So future contract is traded in exchange market. And yeah, for exchange market, it is like strictly regulated at the national level. And all of the contract in the exchange market are standardized. So they are standardized in terms of the date, in terms of the price, in terms of the amount, and in terms of the quality of the goods and product traded in the exchange market. And one difference between the futures and the contract is that for future contract, we have a clearing house. Okay. So what is a clearing house in this case? So if you look at the forward contract, you can see that, yeah, party A and party B will make transaction directly with each other. Okay, so these two parties will meet each other and they will have like direct transaction with each other. But the story is a little bit different when we talk about the future, because for the future we have a clearing house. Okay, so yeah, the clearing house will be someone standing between the buyer and the seller. Okay, so the clearing house is also as the exchange. Okay, so if you are the buyer of the future, you go to the exchange. Okay, and if you are the seller, you also go to the exchange, and you could put the price. You could put the price at which you want to buy the futures, and the exchange will try to match the price of the buyer and the price of the seller. If they have the equal price to each other, then the exchange will match the buyer with the seller of the same goods and product. Okay, so that is the same thing you observe in the stock market. Yeah, so if you want to buy some stock, you also have to set your own price. And if your price is appropriate and is matched with other sellers of that stock, then the exchange will help you to buy the stock from that investor. So this is the same thing for the future. The party A here, the buyer of the goods and product here, also come to the exchange and put their own price. And if their price is matched with the seller of the goods here, then the exchange will connect these two parties and the transaction can be executed. Okay? And in order for the parties to make transaction of future contract, they have to make some deposit, normally 10% of future price, before entering the transaction. So this is the requirement of the future exchange. And why do we need this requirement? So if you look at the forward contract, this is the transaction between the two parties, and they make transaction directly with each other. But because transaction happen in the future, so it is like it also have some cases that one party will not yeah, this party, for example, party B, they will not execute the transaction as promised. So let's say after 1 year, if the selling price, the market price of the coffee bean increased to $1,400, so Patty B may have some like uh, uh, idea to withdraw from the contract and sell 2 tons of coffee bean to the market to get this price. And in this case, you can see that Party A in this case, they will suffer from a counterparty risk. It is the risk that the other party will not execute the transaction as promised. So in this case, one of two parties, the other party, they will suffer from a huge loss from the contract. But if we have like some deposit like this, okay, each party have to make deposit before entering the transaction. So they will have to have some responsibility when they decide to involve in the transaction. And the clearinghouse and exchange here, it also have daily settlement of gains and loss for each party. So what does this mean? Okay, so yeah, if you look at the forward contract, yep, you can see that. Yeah, the forward contract. So the exercise price is $1,300, and after 1 year, the market price is $1,400. So we will realize a gain and loss for each party A and B after 1 year. But the daily settlement in this case is that the party A and party B will be realized gain and loss after every day. Okay, after every day. So let's say it's still the situation of coffee bean, and we have the account of party A and the party B here. Let's say they have to deposit $130 for the exchange. Okay, so the both of these two parties have $130 in their account in the exchange in order to entering transaction. So they have to put $130 in their account. Okay, so there is 10% of the price of the contract. And yeah, let's say today, 24 November 2023. So we assume that tomorrow, let's say tomorrow, okay, 25 November 2023, if the price of the coffee beans in the future exchange increase, let's say to $1,305. So tomorrow, the price of the coffee bean is $1,305. So in this case, because the market price increased, therefore you can see that the buyer will be the beneficial party. Okay, because like $1,300 is the contract price, what they have to pay, and $1,305 is the market price. Okay, so they can save $5 from participating in the market. So obviously, if the price of the goods and product of the underlying asset increase, then the buyer of the underlying asset will be beneficial. And here, in the 25th of November, the exchange will recorded a profit to party A. So the account of party A will be $135. And this $5 is taken from the account of party B. Okay, so now the account party B is only 125. Okay, and let's say in 26th of November 2023, the price of the coffee bean still exchange, and it, like, let's say, decrease to $1,290. Okay, so the coffee bean price decreased by $15. And in the case that the price of the coffee bean decreased, then the beneficial party now could be the seller of the underlying asset. And yeah, their account would be added $15 of profit. Okay, so the new value of the account of party B now would be 140. And yeah, for party A, his account will be deducted by $15. So the new value of the account of party A now is only $120. So you can see that for the case of future contract, the account of each party could be adjusted daily. Okay, it is opposite from forward contract. For forward contract, we only calculate the payoff for party A and party B at the end of the contract. But for future contract, the account of party A and party B will be adjusted daily. And here we call it as the mark-to-market process. Okay, mark-to-market process. And this process also minimize the risk to the parties that involved in the future contract. So if you compare between forward contract and future contract, obviously future contract is much safer to the participants because they are protected by the exchange, they are protected by the mark-to-market process. Everything is standardized, and yeah, no risk of counterparty, no risk of like low quality of goods or product, or like some let's say some fraud, just activities and fraud behavior from the participants of the market. Okay. Okay, so that is for the future contract. And the final type of the derivative we will learn is the option contract. Okay, option contract. So when we talk about the future contract and the forward contract, whenever the party A and the party B decide to involve in the contract, then they will have the responsibility to perform the contract as they promised. Okay, either the event in the market is good or bad to them, they will have to execute the contract. No matter they have the gain or loss, they still have to execute the contract. And that is some disadvantages of forward contract and future contract. But if these two parties they decide to participate in an option contract, then it will not be their responsibility to execute the contract, but they will have the right. Okay, they will have the right to execute the contract or not. So if the market situation is beneficial for them, then they will decide to execute the contract. But if the market situation is not beneficial to them, they can decide not to execute the contract. So it is the right for the participant. Okay? So yeah, an option contract offers the buyer the right but not obligation to buy or sell the underlying asset at a fixed price, either on a specific expiration date or at any time prior to the expiration date. So option contract is traded on an exchange, and therefore, yeah, it is standardized and it is strictly regulated by the regulators. Okay, and how can you understand the situation of who is the buyer now? So if you look at the contract, the forward contract between party A and the party B, in our previous example, you understand that party A is the buyer and party B is the seller, right? And the buyer and the seller in this case is the buyer and seller of underlying asset. Okay, so remember this point: buyer and seller of underlying asset. But when we talk about the option contract and the buyer in this case, so the buyer here is not buyer of underlying asset, but the buyer here is the buyer of contract. Okay, so let's see. Now we have another party in the market. Okay, so we have the party C. So who is the dealer, for example, dealer, and he involved, he participates in the derivative market. So this party C here, he can go to the party A and offer to sell to party A an option contract. Okay, so offer to sell an option contract to party A. So this party C is the seller of contract, and party A here is the buyer of contract. Okay, and party C offer to party A an option contract that after 1 year, the party C will sell 2 tons of coffee bean at the price of $1,300 after 1 year. Okay, and the party A will have the right to buy 2 tons of coffee bean at the price of $1,300 after 1 year. So this is the right to the party A. What does this mean by the right here? The right here is means that after 1 year, if the market price of coffee bean is $1,400, so which is very favorable to party A in this case. So obviously, if the party A look this contract, the contract price is $1,300, and he compare with the price of the market, and he see that obviously going with the contract is beneficial for him. So he will choose to execute the contract. So he will choose to buy 2 tons of coffee bean from party C at the price of $1,300. But if the market situation is not favorable to party A like that, let's say after 1 year, the market price of coffee bean is only $1,500. Okay, so in this case, party A can, he can think that executing the contract is not beneficial for him because the contract price is now higher than the market price, and he would rather go into the market to buy coffee bean instead of buying coffee bean from party C in this case. So the party A will have the right to not executing the contract. Okay, so he will reject the contract and go to the market to buy coffee bean. So that is the right for party A in this case. Okay, this is the right, not the obligation or not the responsibility of the involving party. Okay, and that is the option to buy the contract. And the option to buy the contract, we call it the call option. Okay, option, a call option give the holder the right, but not the obligation to buy the underlying asset at a specific price on or before expiration. Okay, and yes, if you're looking back at the example and you do the same for the other side. So in addition to selling the option contract to party A, party C also offer another contract with party B in our case. Okay, so party C here go to party B and offer an option contract. Okay, option contract. So in this contract, party C offer to buy from party B 2 tons of coffee bean at the price of $1,300. And now party B will have the right to sell. Okay, so in this contract, party B is also the buyer of contract from party C, and in this contract, the party B will have the right to sell. So what does this mean by the right to sell here? So in the case that the market price of the coffee beans is $1,050, then obviously selling coffee beans to party C would be much more profitable than selling to the market. And party B would decide to execute the contract. But if the market price of the coffee bean is $1,400, so in this case, party B would rather go to the market to sell the coffee bean at this price, and he will close the position in the contract. Okay, so he will deny to sell the coffee bean to party C in this case. And because here is a option contract, so party B already obviously have the right to do so. He will not have to perform or execute the contract if he does not want to do it. Okay, so in this case, you can see that the buyer that we have here is the buyer of the contract. In our case, the buyer of the contract here is a party A and party B, right? Party A and party B are the buyer of the contract. And here, party C is the seller of the contract. He sells the option to buy. Party C here sells the option to buy to party A and sell the option to sell to party B. Okay, so by involving in the transaction, the party A will have the right to buy some underlying asset from party C, and similarly, party B will have the right to sell some underlying asset to party C. Okay, and in order to have this right, now party A and party B do not have the obligation, but they have the right. And in order to have this right, the party have to pay something we call the option premium to party C in this case. Okay? They have to pay some option premium at the initial of the contract. So when these two parties, party A and party C, sign the contract with each other, then party A has to pay some option premium to party C in exchange of his right. Okay? And similarly, party B also have to do the same thing. He has to pay some option premium to party C in order to have some right in the contract. Okay? So at the end of the contract, let's say after 1 year, then party C, who is the seller of the contract, has to perform following the decision of the buyer of the contract in this case. So if the buyer of the contract, the party B or the party A in our case, they decide to execute the contract, then party C has to do so. And otherwise, if party A and party B do not want to execute the contract, then the party C also have to follow the decision of the party A and party B. So you can see that the buyer of the contract who has the right, okay? And in order to have that right, they have to pay some option premium to the seller of the contract at the beginning, okay? So this party C here, they will have some premium, some fee from the option contract, and party A, party B will have some right, okay? And yes, if the party A, they want to have some right to purchase the asset, then we call it the call option. And if the party B involved in the contract that he has the right to sell the asset, then we call it the put option contract. Okay, put option contract. The put option gives the holder the right, but not the obligation to sell the underlying security at the strike price on or before expiration. Okay, and yes, in the case of call and put option, how can we calculate the profit or loss to the participants? Okay, how can we calculate the profit or loss to the participants? Okay, so if you consider the call option, so the call option is the option to or the right to buy an underlying asset. Okay, so you consider the situation between party A and party C in our example. So yes, let's say for example, at the beginning of the contract, party A already pays some option premium, which is $1,500 to party C. So this one is the option premium, and they have an option contract in which the party A will have the right to buy 2 tons of coffee beans at the price of $1,300. Okay, so this is a typical co-option contract. Okay, so this one is option premium. Okay, so how can we calculate the profit or loss of each party in this case? So for the buyer, yes, in this case, so you can see that if the market price greater than the exercise price, okay, so if S1, let's say $1,400, okay, so the market price greater than the exercise price here. So you can see that obviously party A, who is the buyer of coffee beans or buyer of underlying asset, this party will choose to execute the contract, and he will buy coffee from party C at the price of $1,300. Okay, and what is the profit to party A in this case? You can see that he can save $100 per ton of coffee bean and multiply by 2, which is $200. Okay, but at the beginning of the contract, he already paid $50 as the option premium to party C. So basically, the profit for party A in this case is only $200 is the cash inflow, what he saved from participating in the contract, and minus 50, which is what he has to pay to the seller. So the profit of party A in this case is only $150. Okay, so the profit here for the case of $1,040 is only, this one is 150. So if we do not have the option premium, then the payoff for the buyer will be this line. But because of the option premium here, then yeah, this one will be $50 of option premium. Okay, and therefore the the profit for the actual profit for the buyer of the contract is only this line. Okay, this second line. Okay, so the actual profit. So that is for the buyer of the call option. And you can see that in the case we have, if the market price of the coffee bean is equal to the contract price. So let's say after 1 year, the market price is $1,300. So in this case, buying coffee beans from the market or buying coffee beans from the contract is the same to party A. Yeah, because they have the same price. So the party A can choose to uh, execute or not with the contract. But in this case, you can see that the profit for party A in this case will be equal to, yeah, he does not gain anything from participating in the contract, and therefore the profit is zero. But he already paid $50 at the beginning of the contract. Therefore, the profit to the party A in this case will be minus $50, which is the value of the option premium. So in the case that the spot price equal to exercise price, you can see that the buyer will suffer from a loss which is equal to the option premium. Okay, and yeah, and if we have some case that the market price less than the exercise price, so let's say, yeah, after 1 year, the market price of the coffee bean is $1,050. Okay, $1,050. So party A will compare between the market price and the contract price, and he see that the market price will be better for him. So he decide not to execute the contract, and instead of buying coffee from party C, he will go to the market and buy the coffee beans. And in this case, you can see that the party A will not execute the contract, and the maximum amount that he lost in this contract is the option premium. Okay, so you can see that if we compare between the option contract and the forward contract, when the spot price become like very low like this, for the forward contract, the loss to party A is $500. But because of participating in the option contract, now party A can limit his loss at the $50, minus $50 only. And that is like one advantage of the option contract if you compare with the forward contract. Okay, and to derive the payoff or the value for the party C in this case, so just remember that derivative is the zero sum gain. So the gain or the profit for one party would be the loss to another party. So if the, yeah, if the payoff, if the profit to the buyer, they have the graph like this, then you can draw the graph for the seller. You can like, yeah, if the profit for party A is minus $50, so the profit for party C could be plus $50. Okay, and yeah, when the profit to the party A increase over time, then the profit for party C will decrease over time. Okay, and yes, you can apply the same process and the same thing for the put option contract between party C and party B. Okay, so you can still assume that the initial option premium is $50 and the contract here is still like 2 tons of coffee bean and the strike price or the exercise price is $1,300. Okay, and you can assume 3 situations. The first one is when the market price greater than the exercise price. So let's say the market price is 1,400. Okay. The second situation is when the spot price and the market and the strike price are equal. So 1,000 and 1,300. And the third situation is when you have the market price is lower than the strike price, so $1,050. So what is the payoff and the profit for each party in each case like this? So please do it at home and try to draw the graph like this. Okay, everyone? You clear? Yes or no?
Yes.
Okay, very good. So that is all for our chapter 3. So, okay. Như vậy chúng ta học xong hết nội dung của 3 chương rồi đúng không ạ? Và chúng ta sẽ thi giữa kỳ, có bài thi giữa kỳ vào thứ 3 tuần tới. Thì theo như cái danh sách của lớp mình, hôm trước cô lấy được thì lớp mình có 99 bạn. Thì cô dự định là sẽ chia ca thi cho lớp chúng ta. Thì các bạn sẽ thi làm 2 ca. K1 là sẽ số tự từ bạn thứ nhất đến bạn thứ 50. Được chưa ạ? Và ca thứ hai sẽ là bạn số tự 51 đến 99. Thì danh sách lớp cô đã gửi cho bạn Nhi rồi đấy ạ. Thì các bạn có thể dựa vào cái danh sách lớp của Nhi để xem và kiểm tra số thứ tự của mình. Đây, để cô xem file luôn nhé. Ok, K1 của chúng ta sẽ thi là từ bạn số 1 là bạn Vũ Minh An. Được chưa ạ? Bạn Vũ Minh An đến bạn số 50 là bạn Nguyễn Thị Bảo Linh. Đấy là cái thi số 1 ạ. Còn cây số 2 là từ bạn số 51 là bạn Nguyễn Thị Thùy Linh ạ. Nguyễn Thị Thùy Linh đến bạn số 99 là bạn Nguyễn Lê Vi. Đó, thì đó là cái thứ tự ca thi của các bạn ạ. Thì mỗi ca thì K1 chúng ta sẽ thi bắt đầu từ 12 giờ 30 đến 1 giờ 30, được chưa ạ? Và K2 các bạn sẽ thi từ 13 giờ 30 đến 14 giờ 30. Thời gian thi cho mỗi ca là 40 phút ạ. Và chúng ta sẽ thi dưới dạng tự luận. Chúng ta sẽ có tất cả là 4 câu hỏi tất cả. Và các bạn sẽ làm trong vòng 40 phút. Thì 4 câu hỏi tự luận đấy sẽ có 2 câu hỏi là về phần lý thuyết và 2 câu hỏi là về bài tập tính toán. Thì thật ra là chúng ta chỉ học 3 chương thôi, nên là cô nghĩ là chúng ta sẽ gói gọn và chúng ta không có phần giới hạn kiến thức, bởi vì thực ra là cái kiến thức chúng ta học nó cũng không quá nhiều. Thì chúng ta sẽ cover hết tất cả những kiến thức trong những cái buổi chúng ta học vừa rồi ạ, là nội dung thi giữa kỳ của các bạn. Thì các câu lý thuyết và các câu bài tập nó cũng sẽ nằm trong 3 cái chương đó. Bài tập thì chắc chủ yếu các bạn sẽ chỉ có bài tập ở chương 2, chương 3 thôi. Thì các bạn sẽ cố gắng là luyện tập lại những cái bài tập chúng ta có trên lớp, cũng như là luyện tập những cái file bài tập mà cô gửi cho các bạn về nhà đấy ạ. Còn lý thuyết thì chúng ta sẽ ôn cả của chương 1, chương 2 và chương 3. Được chưa ạ? Thì đấy là về cái việc mà chúng ta sẽ thi vào tuần sau ạ. Thế còn đối với bài mini test thì thực ra thì đợt vừa rồi có một số bạn cũng hỏi cô là về cái đáp án rồi là về cái cách giải vân vân ý. Thì cô cũng có nói với lớp đấy là cô cũng không gửi đáp án cho lớp mình, bởi vì là cái test này của chúng ta thì có thể ở lớp mình cô chỉ đưa ra cho các bạn để làm cái attendance check, nhưng mà ở lớp khác thì nó có thể là một cái bài test hoàn chỉnh, nên là cô sẽ không cung cấp đáp án để tránh bị gọi là bị lộ đề hoặc là bị ảnh hưởng đến cái kết quả thi của các bạn. Tuy nhiên thì có một số bạn thì hỏi cụ thể hơn về những cái bài tập liên quan đến gọi là mortgage và các cái bài tập về trả góp ấy ạ, trả góp đúng không? Thì cô thấy thường các bạn sẽ băn khoăn về những cái bài đấy và chúng ta hay hỏi xem là nếu như mà trả góp như vậy thì cái phân tách giữa principal amount và interest amount sẽ như thế nào? Thì thứ nhất là đấy là một dạng. Một dạng thứ hai các bạn cũng hỏi về ví dụ như ở đây bài số 5 này, bài số 5 thì chúng ta đang có hai loại khoản đầu tư đúng không? Thứ nhất là cái khoản đầu tư của các bạn đang dự kiến xem xét, đấy là một cái securities mà pay chúng ta là $500 vào mỗi 6 tháng. Và cái security này thì đề bài cho rằng là nó có cái equal risk với một cái security khác mà nó có kỳ hạn là 10 năm này, trả lãi là 10% và compounded monthly. Tức là các bạn sẽ thắc mắc là tại sao chúng ta lại cần phải có cái thông tin này và cái compounded monthly với lại compounded semi-annually thì nó khác nhau như thế nào và liệu thì cái 500 every 6 month này nó có tương đương với $1.000 annually hay không? Đó thì một số bạn đã hỏi cô cái câu hỏi như vậy thì cô cũng giải đáp luôn với lớp mình. Đấy là khi mà các bạn cho được đề bài cho hai cái loại tài sản đầu tư mà nó có equal risk thì cái signal ở đây là nó muốn nói các bạn rằng là cái return của hai cái security này nó cũng phải như nhau, đúng không ạ? Bởi vì chúng ta có một cái tài sản tài chính A và một tài sản tài chính B. Nếu như nó có risk như nhau thì cái return của nó cũng phải như nhau. Bởi vì nếu như hai cái mà có cùng risk và một cái mà có return lớn hơn ấy, thì cái còn lại nó sẽ không trade, nó sẽ không bán hay là mua bán được trên thị trường. Bởi vì investor họ sẽ mua tài sản B chứ họ không mua tài sản A. Bởi vì rõ ràng là cùng có cái mức độ rủi ro như nhau, nhưng tài sản B có lợi nhuận cao hơn thì họ sẽ mua tài sản B chứ họ không mua gì tài sản A, đúng không ạ? Cho nên là nếu như mà hai tài sản có equal risk thì chúng ta sẽ mặc định nghiễm nhiên đó là nó phải có cùng cái rate of return. Vậy thì rate of return ở đây thì chúng ta sẽ hiểu rằng là gì ạ? Cái EAR của hai tài sản này nó phải giống nhau. Tức là cái real rate of return và on annual basis của nó phải như nhau, đúng không ạ? Thì nó mới gọi là cùng một rate of return chứ. Annual return. Ok. Vậy thì bây giờ muốn hai cái tài sản này nó có cùng EAR thì các bạn sẽ tính xem là với cái tài sản thứ nhất, cái tài sản mà các bạn đang xem xét ạ, EAR của nó sẽ tính như thế nào. Thì các bạn giả định rằng là với một cái security mà nó trả $500 vào mỗi 6 tháng, đúng không ạ? Có nghĩa là gì ạ? Khi mà chúng ta vẽ cái timeline về đổi thời gian này ra nhé, các bạn sẽ có 0 là thời điểm hiện tại, đúng không ạ? Chúng ta giả định như là năm thứ nhất thì các bạn viết là số 1, năm thứ hai bạn viết là số 2 này. Và cứ 6 tháng chúng ta nhận tiền một lần. Như vậy là giả sử như là ở đây chúng ta có 0.5, tức là sau 6 tháng đấy ạ. Chúng ta có 1.5, đúng không ạ? Chúng ta có 2.5, vân vân. Và các bạn nhận được $500 vào sau mỗi 6 tháng. Thì các bạn sẽ thấy rằng là khi chúng ta nhận $500 vào mỗi 6 tháng như thế này ạ, thì rõ ràng là cái $500 đầu tiên này nó được nhận sớm hơn so với $500 tiếp theo. Và điều đấy có nghĩa là gì ạ? Nó sẽ khác với việc là các bạn tính số tiền chúng ta nhận được là $1.000 một năm. Đúng không ạ? Các bạn nhớ rằng là khi chúng ta nói đến time value of money, có nghĩa là $1 today is worth more than $1 tomorrow. Và điều đó có nghĩa là những cái cash flow ở các thời điểm khác nhau, các bạn không so sánh được với nhau. Chúng ta cũng không thể nào chỉ đơn giản là cộng nó vào với nhau được. Mà với cái $500 ở 6 tháng đầu tiên ạ, thì các bạn sẽ thấy rằng là gì ạ? Bây giờ hỏi rằng là sau 1 năm tôi có tổng bao nhiêu tiền ấy, thì tôi không phải là lấy 500 này cộng 500 này các bạn ra 1.000, mà các bạn sẽ phải đầu tiên là các bạn đưa cái $500 đầu tiên này, $500 này, nó đến thời điểm năm thứ nhất, nó sẽ là 500 và nhân với 1 cộng R, đúng không ạ? Và cộng với 500 này thì sẽ ra được là tổng số tiền chúng ta có được sau 1 năm và chắc chắn nó sẽ khác với cái giá trị $1.000. Cho nên là khi đề bài đã nói là pay $500 every 6 months thì các bạn sẽ hiểu rằng là nó sẽ khác với $1,000 every year. Được chưa ạ? Nó sẽ khác nhau. Và bây giờ việc của chúng ta là chúng ta phải tính cái rate, đúng không ạ? Cái rate Ở đây thì cái khoản tiền các bạn sẽ được nhận là sau mỗi 6 tháng. Cho nên là nếu như các bạn mà muốn, dùng những cái công thức thì các bạn luôn luôn nhớ rằng là gì ạ? Cái cash flow và cái interest rate nó phải được đo lường trên cùng một khoảng thời gian, nó phải có cái sự consistent. Vậy thì nếu bạn dùng cash flow là semi-annually thì cái interest rate này nó cũng phải là semi-annual interest rate, đúng không ạ? Chúng ta phải tính cái R của 6 tháng. Và làm thế nào tính được cái R của 6 tháng? Thì ở đây nhá, với cái security thứ nhất ạ, thì các bạn sẽ thấy rằng là gì ạ? Các bạn muốn tính EAR của cái security thứ nhất, nó sẽ chính là bằng gì ạ? 1 cộng R tất cả mũ 2, đúng không ạ? Trừ 1, các bạn sẽ ra EAR của cái khoản đầu tư thứ nhất. Với R ở đây là cái semi-annual interest. Ở đây cô đang tính là cái rate cho 6 tháng ạ. Một cái period của chúng ta là 6 tháng. Thì trong một năm ạ, trong một năm ở đây chúng ta sẽ có 2 kỳ tất cả. Cho nên là chúng ta sẽ lấy là một cụm R bình phương và trừ 1 để ra được cái EAR1, đúng không ạ? Thế còn với cái khoản security thứ hai thì nó sẽ trả 10% và cái 10% này nó sẽ được compounded monthly. Cho nên là cái EAR của khoản đầu tư thứ hai nó sẽ được tính bằng cách là gì ạ? Lấy 1 cộng 10% chia cho 12 tất cả mũ 12 và trừ 1, đúng không ạ? Và vì hai khoản đầu tư này nó có cùng risk cho nên nó sẽ phải có cùng return và bạn sẽ lấy làm sao để cho EAR1 bằng EAR2. Thì khi mà các bạn để hai cái phương trình nó bằng nhau như thế này thì các bạn hoàn toàn có thể tính ra được cái giá trị của R. Và các bạn dùng giá trị của R này để chúng ta apply vào công thức và các bạn tính ra được cái price của cái security. Thì đấy là cách mà chúng ta sẽ làm với cái dạng bài tập kiểu như thế này. Được chưa ạ? Đấy là cái thứ nhất. Cái thứ hai là với những cái bài tập liên quan đến mortgage, đúng không ạ? Mortgage. Ở đây ví dụ như là bài 10. Thực ra bài 10 này thì đáp án nó không đúng ạ. Cô có check lại và cô thấy là đáp án nó bị sai. Nên là khi mà cô chấm bài các bạn thì cô cũng sẽ lưu ý cái điều này. Đấy. Thì đối với bài thứ 10 này thì các bạn có là một cái khoản một cái ô tô nó có giá là 15.000 đô, đúng không ạ? Và nó là recently loan. Có nghĩa là cái 15.000 này nó là cái present value của cái car, đúng không ạ? Và để mà có 15.000 đô để các bạn có tiền mua ô tô, bạn phải đi vay 15.000 đô này ở ngân hàng và bạn sẽ phải trả nợ cho ngân hàng những cái khoản gọi là installment hoặc là equal payment in 5 years, đúng không ạ? Vậy thì các bạn sẽ hiểu rằng là gì ạ? Ở đây chúng ta có PV là 15.000, đúng không ạ? Chúng ta có rate là 12% và chúng ta có cái payment là monthly payment, đúng không ạ? Cái A của chúng ta là monthly. Và vì các bạn vay khoản này trong 5 năm cho nên là cái T chúng ta sẽ bằng 60, đúng không ạ? Vậy thì điều này có nghĩa là gì? Điều này có nghĩa là các bạn sẽ có đây, mỗi cái khoảng này chúng ta sẽ có là các khoản tiền chúng ta trả hàng tháng. Thời điểm hiện tại là 0 này. Các bạn có tháng thứ nhất, tháng thứ hai, tháng thứ ba, tháng thứ tư, vân vân. Đến tháng thứ 60, đúng không ạ? Và mỗi tháng các bạn trả một khoản tiền là A. Mỗi tháng các bạn trả một khoản tiền là A. Và cái gọi là principle, cái nguyên tắc để chúng ta tính được cái giá trị A này đó là gì ạ? Đó là A sẽ là cái giá trị làm sao cho là gì ạ? Khi mà các bạn discount về thời điểm hiện tại thì nó sẽ ra được giá trị của PV, đúng không ạ? Chúng ta sẽ có là 15.000 nó sẽ bằng với A chia cho R, đây là 12%. Nhưng mà 12% này là 1 năm, đúng không? Chúng ta sẽ phải chia cho 12 tháng. Cho nên là đây sẽ là 1% và nhân với 1 trừ đi 1 chia cho 1 cộng 1% và mũ ở đây là mũ 60, đúng không ạ? Thì các bạn sẽ tính ra được cái giá trị A này. Và cái A này nó là monthly payment. Thì đề bài hỏi các bạn là what would be the remaining balance of the loan after you make the 30 payment? Tức là sau 2 năm rưỡi, đúng không ạ? Sau 2 năm rưỡi các bạn đã trả được 30 khoản monthly payment rồi thì cái phần principal amount chúng ta còn lại là bao nhiêu? Thì đề bài đang hỏi chúng ta là như vậy. Thế thì để giải được cái bài này mà chúng ta không cần dùng Excel ạ, thì các bạn sẽ làm thế nào? Các bạn sẽ hiểu rằng là gì ạ? Khi các bạn dùng công thức PV bằng A chia R nhân với 1 trừ đi 1 chia 1 cộng R mũ N như thế này ấy, các bạn tính ra giá trị PV ấy, thì cái PV này nó chính là cái principal amount của cái khoản vay. Đúng không ạ? Và cái 15.000 này là giá trị ở thời điểm hiện tại. Vậy thì giả sử như các bạn đã trả xong 30 khoản rồi, đúng không? Giả sử đã đến time thứ 30 và chúng ta còn 30 khoản A nữa chúng ta phải trả. Vậy thì khi mà các bạn discount 30 khoản A này về thời điểm năm thứ 30 ạ, thì các bạn sẽ ra được là cái principal amount tại tháng thứ 30. Được chưa ạ? Như vậy là nếu như các bạn discount 30 khoản A còn lại về năm số 30 này thì các bạn sẽ ra được cái principal amount sau 30 tháng và nó sẽ chính là cái remaining balance of the loan. Thì các bạn chỉ cần áp dụng công thức thôi, đúng không? A chúng ta vừa tính ra ở trong cái công thức này. Các bạn chia cho 1% và nhân với 1 trừ đi 1 chia cho 1 cộng 1% mũ 30. Đó, thì các bạn sẽ ra được cái giá trị PV. Và PV này sẽ chính là cái khoản gốc còn lại mà chúng ta chưa trả sau 2 năm rưỡi. Và nó sẽ đáp án của bài số 10 này. Đó. Thì đấy là cách mà chúng ta sẽ tính toán với những cái bài liên quan đến mortgage hoặc là advertising loan, nó sẽ là như vậy. Chúng ta còn hỏi gì nữa không ạ? Về bài tập, về bài test hoặc là về những cái vấn đề các bạn gặp trong quá trình ôn thi, các bạn còn hỏi gì không? Đã mình hết câu hỏi rồi đúng không ạ?
Cô ơi, mình làm bài thi trong bao lâu vậy ạ?
40 phút em ạ.
Dạ vâng ạ.
40 phút cho 4 câu tự luận.
Cô ơi, 2 câu lý thuyết nó sẽ là short answer hay là mình phải viết ra thành kiểu essay ạ?
Không essay em nhé, không essay. Em chỉ cần trả lời theo đúng cái ý. Chẳng hạn như là cô hỏi các bạn là phân biệt giữa preferred stock và bond chẳng hạn. Chẳng hạn như thế thì các bạn sẽ thấy rằng là mình chỉ cần viết ra một vài những cái ý chính thôi, đúng không? Nên chúng ta không cần phải viết thành một cái bài essay dài, các bạn chỉ cần đi vào key point là được.
Em nói cô là sẽ chỉ thi vào trong những gì mình đã học thôi đúng không ạ?
Trong nội dung chúng ta thảo luận trên lớp, trong textbook mà cô gửi cho các bạn và trong những cái practice exercise. Chúng ta còn hỏi gì nữa không? Ok, hết câu hỏi rồi đúng không ạ? Rồi, thế thì lớp mình nghỉ nhá. Và các bạn chúc các bạn thi tốt ạ, để chúng ta sẽ có một bài thi thật là ổn vào thứ 3 tuần sau. Vậy lớp mình nghỉ nhá.
Nhờ cô ạ.
Chào cô ạ.
Chào
Rồi,
cô.
cả lớp ạ.
Chào
Chào
cô.
cô ạ.
Ok, bye.
Chào cô ạ.
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 Ok, goodbye.